In this video, we're going to discuss buying a property within your superannuation. We're also going to confront some of the myths and misconceptions surrounding this strategy. In this video, you will learn 1. Who can buy a property in super? 2. How much super you need to get started? 3. How it operates? 4. What the tax incentives are? 5. What type of property you can buy? 6. How the strategy compares to your current super fund? 7. Who can set this up and look after it for you? The first thing you'll need to do to buy property with your super is establish a self-managed super fund. And so long as you're 18 years and older, an Australian resident, not bankrupt, and do not have a criminal record relating to dishonesty offences, you are eligible to become a trustee to your own self-managed super fund. You can have up to 4 members in an SMSF, effectively pulling your resources to buy larger assets, and whilst we usually see husband and wife teams, the 4 members can be siblings, adult children, friends, or really anyone who's eligible. Each member's relative balance is quarantined within the fund, so you are always able to identify individual balances even when there's borrowing involved. The SMSF can be used to buy properties as well as other assets including shares, bonds, managed funds, etc. The earnings generated from these assets will go back into your SMSF where the benefits will be paid to the members at retirement. With recent changes to the bank's borrowing policies, all members will now need to combine super balances of at least $120,000 to get started. This will depend on a few things, such as the value of the property, your income, and the financer you choose. There are only a handful of funders or banks that do SMSF lending. Quantum Finances is able to source a funding package for you. So please refer to the sample provided at the end of this presentation, and we can calculate your fund's borrowing capacity. A simple example is a great way to see how this all works. In the case study, we will use John and Jane. Both of them are currently working. John has a super balance of $160,000 and Jane has a super balance of $90,000 in their super accounts at work. They combine their super balances and roll over. This means they transfer, tax-free, their existing super balance, in part or whole, into a newly formed SMSF. If you're a government employee or don't have a choice of where your super gets paid to, you can usually transfer a majority of your funds into the SMSF, leaving just the minimum balance required in your existing fund. This leaves a balance in your employer fund to cover any insurance costs, which is also a good idea. You should, of course, refer to a professional advisor, so Quantum can help in this regard. In our case study, John rolls over $150,000. Jane rolls over $80,000. Both of them keep $10,000 each in their current employer's funds, giving them a combined SMSF total of $230,000. So, John and Jane decide to invest $230,000 into a newly formed SMSF and set up an investment plan to invest, say, $96,460 into a shares portfolio and $11,500 in cash, with $122,040 available for the deposit and costs for a new investment property. They have found a new property. In this example, the purchase price is $369,000, of which a 10% deposit of $36,900. They can obtain a loan of 70% of the property value, in this case, $258,300. And with the SMSF, pays stamp duty at, say, $11,340. So the remaining balance of the SMSF required at settlement is $73,800, or total cash used is $122,040. So the steps required to purchase a new or investment property. You first need to set up an SMSF with your existing super monies. Set up a bare trust with your SMSF. Place your deposit into your investment property. Obtain your loan from the bank to settle the property. The concept of using a SMSF to purchase an investment property would fall under what's called a bare trust. This is typically a trust established to allow a SMSF to purchase assets that will be geared. Regulations require that the property acquired with borrowed monies must be held by a bare trust, with the SMSF being the beneficiary of the trust. The bare trust is merely the registered holder of the property until the loan is repaid. The SMSF will receive rental income from the tenants and pays interest to the lender. If and when the loan is repaid, the legal ownership of the investment property will revert to the trustee of the SMSF. This, in most instances, requires a corporate trustee for both entities, again, dependent on the lender's requirements. When a SMSF decides to buy the property, the trustees of the bare trust enter into a contract of sale to purchase a property, not the trustee of the SMSF. The trustee of the bare trust is the entity registered as the owner upon completion at property settlement. Once the property settles, the rental income, say approximately $440 per week, will bring in $22,880 per annum. However, after expenses, say $6,667 has been paid, the net income is $16,213. The SMSF loan of the property will be $258,300. And this is a limited recourse loan from a bank, meaning the bank takes security over the property only and not the total balance of the funds in the SMSF. If the yearly loan payment at, say, 5.75% is $18,088, which is including principal and interest over 30 years, this leaves a shortfall of about $2,000 per year. This shortfall of $1,875 is covered by other income from other assets or further contributions made via rollovers from employer funds or personal contributions by John and Jane directly to the SMSF. These contributions are generally also tax deductible for each of them as well. The shortfall and the depreciation can be a tax deduction in the SMSF, providing tax benefits to offset taxes within the SMSF from contributions. So over time, the property of course earns an income in the form of rent, which is paid back into the SMSF cash account and used to repay the loan. All employer contributions and any dividends from shares are also paid back into the SMSF account, while all ongoing costs associated with the property, i.e. mortgage repayments, maintenance costs, insurance, etc., are paid out of the cash account. John and Jane see all the transactions, and Quantum runs this on our online portal, so you can see this on a 24/7 basis. If structured correctly, the assets grow at a capital rate the same as a typical property market. And with the other assets and the loan reduction, real equity is generated in the SMSF. If the property were to grow at 4%, the value in 10 years would grow from $369,000 to $546,210, and the original loan would be repaid from $258,000 to $214,699. While increasing your equity from $122,040 to $331,510 in the property. Of course, this is based upon a range of assumptions that may or may not hold true, and Quantum can provide professional advice to investors on this structure. There are significant tax successions for any assets held inside super, and this includes property. Rental income is taxed at a maximum rate of 15% within the SMSF and not your personal tax rate. This 15% can be reduced even further by claiming all property expenses against the income. Insurance policy premiums can also offset the assessable income. In some circumstances, these deductions can reduce the income tax payable by the fund to zero. So it is possible to negatively gear inside super while still maintaining a positive cash flow to the fund. In addition, the capital gains tax rate on the sale of assets during accumulation phase is a maximum of 10% if the asset is held for more than 12 months. It reduces to zero if it is sold while in retirement. So you can see that buying a property in super can save hundreds of thousands of dollars in tax over the long term. There are a number of rules that relate to a self-managed super fund generally. You can't take money out of your super to buy a property in your own name. Your super monies must stay within the superannuation environment until you meet a condition of release. When it comes to buying property with your super, not all properties are compliant. For instance, you cannot buy a property from related entities, which include yourself. You cannot transfer a property into your SMSF unless commercial, and cannot rent property to a related party, anybody you know. Loans and transactions must be done on commercial terms and at arm's length. If you have used a loan to fund the purchase, you are not allowed to improve the value of the property, cannot renovate. The asset must be deemed a single acquired asset, meaning you cannot buy land and build or buy a block of apartments. Penalties for not complying with these rules are severe and should be taken seriously. On top of that, the vendor or developer you are purchasing from must accept the SMSF transactions. SMSF property purchases are not as simple as normal property transfers and usually require longer settlement times. Lack of experience in this area often causes lengthy delays and can prove costly for the uninitiated. At Quantum Finance, we are able to provide professional credit solutions to complement any property advice or consultation that is provided by Quantum or others to assist our clients get the best possible loan without the stress and with minimal hassle. Our Quantum Finance specialists have the necessary qualifications to guide you to the best loan products from our panel of lenders, from banks and non-banking finance providers. Taking your personal circumstances and following discussions with one of our key representatives, we are able to search through these institutions for the best possible loan product that meets yours and your family's needs. As superannuation is mandatory for all Australian workers that requires contributions to your nominated super accounts, super is one of the most tax-effective ways to invest long-term, and coupled with property, can be a great investment strategy to build retirement assets and influence how much money you will have to retire on and how you live your life in retirement years. There are several banks who offer SMSF lending. Of course, we will do an assessment and discuss which options suit you, which loans are available to you, and what you would prefer. In the table, you will see a comparison from a number of banks and their offerings. The interest rate for a SMSF is generally higher than a typical investment loan or interest only. Generally, as discussed previously, the minimum amount in a super fund required is $120,000 for lender verification. So what are the next steps? First, you will need to find your property to purchase. Once your property is chosen, you then set up your SMSF. Once your SMSF is established, you then set up a bare trust in order to secure your loan to purchase and settle your property.